Thank you for selecting the audiobook. Summary of the book, The Intelligent Investor by Benjamin Graham, summarized by the writing investor. The summary is simplified and digestibly written, so you don't have to invest the time to read the entire book. My personalized summary is written while honoring the book of Benjamin Graham. The Intelligent Investor, written by Benjamin Graham in 1949, is arguably the most important and influential book on value investing ever written. It is considered a Bible for all investors and has made the concept of investing simple and understandable, so even an ordinary individual could become an intelligent investor. Warren Buffett described it as by far the best book ever written on investing. After reading The Intelligent Investor by Benjamin Graham, I realized that while the book offered many valuable insights, some of the concepts and terminologies were quite challenging to understand. To address this, I decided to create a summary of the key ideas and principles from the book. In this summary, I share the core points of value investing and how it can be applied in practice. Whether you are an experienced investor or just starting out, this summary provides an accessible and understandable explanation of the value investing strategy, with the aim of facilitating the understanding and application of these important principles. The chapters we will cover in this summary are, in my opinion, the most valuable chapters. I write the texts in such a way that they are digestible and readable for everyone, as The Intelligent Investor is indeed quite a thick book where extracting valuable information can be challenging. Hence this summary. Chapter 1. Investing versus speculating. Stocks perform well or poorly due to the performance of the companies behind them. It's as simple as that. To be a wise investor, patience, discipline, and eagerness to learn are necessary. Many less wise investors act impulsively, buying and selling positions within a week and expecting immediate results. When these results do not occur quickly according to their expectations, they sell immediately. On the other hand, they sometimes ignore reality and hold on to a particular stock for too long. An intelligent investor knows how to deal with such situations and can control their emotions and think critically. The first step to smart investing is understanding the difference between investing and speculating. Investing involves a thorough analysis of an investment, including assessing risks and potential returns. Therefore, an investment offers the promise of safe returns. Speculation, on the other hand, involves making investment decisions without thorough research and analysis, which can lead to significant capital loss. Sometimes it's very tempting to make choices based on speculation. However, investors should limit their speculative positions, also known as their gambling capital, to no more than 10% of their total investments. To ensure this, it is important to keep the money from the speculative account separate from the money from the investment account so that you can always check that there is no exceeding, causing the share of gambling capital to increase. According to the book, The Intelligent Investor, the smart investor will never exit a position in stocks purely in response to price movements. She should always first ask whether the value of the underlying company has changed and then act accordingly. The intelligent investor only pays attention to the current stock price when it suits him, namely when he wants to sell a share for a good reason. The investor who is deterred by unfounded market declines in his holdings effectively transforms the advantage of his positions into a disadvantage. The main goal of the speculator is to anticipate and profit from market fluctuations. The main concern of the investor is to buy advantageous stocks/securities and hold them at a good price. Investing is not about beating others at their game. It's about controlling yourself in your own game. Most investors fail because they pay too much attention to what the stock market is doing right now, but this makes you short-sighted and ruins your long-term returns. Chapter 2. Inflation and Volatility. Inflation and the fight against it are concepts that have permeated every investor on Wall Street, but contemporary investors often underestimate the importance of inflation, which psychologists also refer to as money illusion. Inflation is a fact and undermines our purchasing power over time. A dollar from 10 years ago has more purchasing power than a dollar today. This means that cash is a poor investment because money simply becomes worth less over time. Imagine getting a 2% raise from your employer while inflation has increased by 4%. Then your purchasing power theoretically decreases by 2%. Therefore, inflation is certainly something to consider. In The Intelligent Investor, it is said that REITs are a reliable investment to combat inflation. Volatility, also known as market volatility, is nothing more than the degree of fluctuations in the market. High market volatility means that there can be large profits and large losses. For many investors, volatility is frightening because they see positions quickly decline or rise in value, which can lead to panic. Remember that you should never sell stocks in panic. Although high market volatility offers opportunities to earn a lot, it also brings risks. How do we deal with volatility? In Benjamin Graham's book, he writes the following. Imagine we own small shares in a private company that cost us $5,000. One of our partners, John, tells us every day what he thinks our shares are worth. Sometimes he values these shares fairly, based on good information and developments and prospects. But sometimes John gets a little too excited and values our shares at ridiculous prices. In this situation, the intelligent investor will not be guided by the value of the shares determined by John. Instead, he must make his own decisions based on his own research. In this situation, you could choose to sell shares when they are ridiculously high and buy shares when the price is ridiculously low. Chapter 3. Stock Selection. The basic characteristics of an investment portfolio are determined by its owners. In the past, investment opportunities were limited. Typically, investments were made in high-quality stocks and bonds. This is because people were not able to take risks with their money. These individuals also had to accept that the ROI, return on investment, reflected this, so the earnings were lower, as was the risk. This still holds true to this day. The risk you take must be proportional to your situation and income. Stock selection for the defensive investor. The defensive investor must consider various criteria when selecting stocks, such as the size of the company, financial stability, earning stability, dividend yield, and price-earnings ratio. Furthermore, according to Graham, the defensive investor should invest a minimum of 25% of their savings in bonds and a maximum of 75% in stocks. It is advisable to avoid buying many stocks in small increments over many years, as this can complicate tax returns and incur more transaction costs. Diversification is essential, but it is also important to keep the number of stocks limited. Start investing in 10 to 30 stocks, no more, and ensure that you invest in multiple sectors. An important note: if you are not willing to thoroughly monitor all your investments, you should not invest at all. Chapter 4. Safety margin. In stock transactions, the safety margin is the difference between what a company is truly worth and the price we pay to buy it. If we can buy a stock at a low price relative to its true value, even if the stock isn't super good, it can still be a good investment. By spreading our money across different stocks, we increase the benefits of the safety margin. Unfortunately, very few people in the world can accurately predict how a company will perform in the future. This is also logical because no one can predict the future, and unexpected things can always happen in the world. Therefore, it is important to always build in a margin of safety because the risk of overpaying for a stock is always present. Having a margin of safety is actually intended to make accurate predictions of the future less important. Provides a buffer for when predictions don't quite pan out. One of the main reasons investors lose money is because they buy low-quality stocks when things seem to be going well, without a margin of safety. By investing only in individual stocks with sufficient margin of safety, the odds are more in our favor. While some stocks will meet our expectations, many others will not. Diversification can enhance the benefits of the safety margin. A diversified portfolio has a higher chance of generating above-average returns. It's clear that building a margin of safety is essential for any form of investment, whether it's trading crypto, investing in stocks, commodities, or real estate. Unexpected circumstances can always arise. The ability to anticipate the unexpected is the strength of a good investor. Implementing margins of safety is therefore vital to minimize risks and increase the chances of success. Let's always be prepared for the unexpected and incorporate margins of safety into our investment strategies to create more certainty for the future. Thank you for listening to the free part of my audiobook. Do you want to read the complete book summary from The Intelligent Investor? Please go to my Etsy page via the link in the description. And don't forget to subscribe and follow my channel for more books to come.